So most entrepreneurs and high income professionals that I work with that are making good money, they often feel like the IRS is their biggest business partner. And if you're watching this video, you're probably in a similar situation. You earn more money, you work harder each and every year, and somehow your tax bill keeps growing faster than your savings. Which is why today I want to show you how high income professionals and business owners can legally stack 3 retirement plans to do 2 things at the same time. And that's to save a massive amount on taxes, and that's also to build serious retirement wealth over time. This isn't about loopholes, this ain't even about shady strategies. It's more about understanding how the rules actually work and using them in the right order. You see, most people think retirement planning is just about picking investments. But for high earners, the real problem usually isn't returns, it's actually taxes. See, if you're in a high tax bracket, every extra dollar you earn could lose 35%, 40%, sometimes even more. And so the real question becomes, how do I move money from my business or from my paycheck into something that's going to benefit me in the future without giving half of it to the IRS every. See, this is where one of my favorite strategies called stacking comes in. So let's start with the base layer. So think of a 401k like a foundation of a house. And so for 2026, you can contribute up to the employee deferral limit. Then you have your employer contributions, and this alone can already save you tens of thousands in taxes. Now this step is important because the contributions reduce taxable income, the money grows tax deferred, and it's familiar and it's very easy to explain to your employees. But here's the catch. For high earners, a 401k by itself often is not enough. See, if you're making $300,000, maybe even $500,000 or even more, maxing out your 401k is like doing leg day once a month and wondering why your legs aren't growing. This is why we build the next layer. Now, imagine you could take business profits, money that you would have already been taxed on, and you redirect that money into retirement savings instead. This is exactly what profit sharing plans do. A profit sharing plan sits on top of the 401k, and here's how it works. See, the business contributes additional money or profits made throughout the year. The contributions are flexible. You're not locked in forever, and the contributions are also tax deductible to the business. This is a game changer because you can reward yourself and key employees. You can scale contributions either up or down depending on the year, and you're still reducing today's tax bill. So at this point, many business owners are already sheltering about 6 figures in taxes. But for the right type of business owner, there's one more layer. And this is where things really change. So let me introduce you to the cash balance. Now, a cash balance plan is like a pension but designed for modern business owners. So instead of saying, here's what the market might do, a cash balance plan, what it says is, here's how much you're allowed to make contributions into. And for high earners, that number could be very large. We're talking about $100,000 plus, $200,000 plus, sometimes even more, because the contributions are based off of age, income, and years until retirement. You see, the closer you are to retirement, the more you're allowed to put away. So most business owners that I work with love this strategy because of the massive tax deductions, predictable contributions, and it gives you the ability to accelerate your retirement savings quickly just in case you're a little behind. See, the cash balance plan is not for everybody, but if it fits, it's one of the most powerful tools in the tax code. So here's a key point that most people miss. These plans are not either or, they're stacked. Think of it like buckets. The 401k is an employee and an employer base. The profit sharing plan is flexible for business contributions, and the cash balance plan is high income, large tax deductions. Each layer reduces taxable income, grows retirement savings, and moves money from being taxed today to later on. So instead of asking how much tax will I owe, you start asking how much tax can I legally avoid while building wealth. The strategy is typically best for business owners, high income professionals, partners or practice owners, and people with consistent cash flow. And it's especially powerful if you're over the age of 30, you have strong, consistent profits within your business, and you want to catch up on retirement savings fast. See, this isn't about complexity for complexity's sake. It's about intentional planning. So here's the key takeaway here. And most people try to invest what's left over after taxes. How high income earners do the exact opposite. They plan first, they stack intelligently, and then they let the tax code work for them instead of against them. So if you're making good money and still feel behind on taxes or retirement, the issue isn't effort, it's all about structure. And structure changes everything. If this saved you a headache with the IRS, like the video, subscribe to this channel, and I'll keep breaking down complex financial topics and planning.